I'm David Scranton, and you're watching the very first weekly edition of a new kind of show. A show that turns its spotlight on personal finance and investment strategies, those which address the needs of the income generation. The question is, are you part of the income generation? Well, let's find out. If you can tell me what people do when EF Hutton talks, or have typed on your Smith Corona before you bought a compact computer, you've read Life magazine, or have shopped at Woolworths, you just might be part of the income generation. Or maybe you once forgot to return a video to Blockbuster. I know I have. Or you paid a bill to Ma Bell, lost sleep over the Soviet Union, or held a mortgage with interest rates as high as 6, 10, or even 18, yes, 18%. If you once invested confidently in the NASDAQ, dropped off film at Photomat, dreamt of owning that new Pontiac or Hummer, watched the McNeil Lehrer NewsHour, booked a flight on TWA, or played with Lionel Trains, there's a pretty good chance you're part of the income generation. Which means you're either retired or want to be able to retire within the next 20 years or so. Welcome to the show designed just for you. For you, my fellow income generation viewers who haven't yet purchased a new Hummer, or a new sweater and gimbals, or haven't flown TWA or any of the other things I've mentioned, your opportunity is long past. These things simply don't exist any longer. But you shouldn't be concerned, because the world always brings unexpected change, and with that change, we have to accept that the things we were once able to do have now been replaced with other opportunities. So even though today toy trains are not made by Lionel, Texas Instruments doesn't make calculators, and you can't watch Louis Rukeyser on Wall Street Week, life's ongoing changes have ushered in many new opportunities in what you can buy, how you can invest, and ways to live. This show is about bringing you new and often simple ideas on how to adapt to the changes that affect everyone, especially in the area of your personal finances, including those decisions that you make on your return on investment, which Social Security options to take, how to manage healthcare costs, major expenses, and even housing. Tonight's inaugural show is part of that ongoing change. Why? Because along with news that directly affects you, the income generation, you're going to find a different tone and atmosphere than most other shows that discuss your money. First of all, you'll notice there's no wild-eyed commentator yelling at you through the television screen. Second, you won't be bombarded with alerts, fast talk, flashing lights, bells, or bright sets. That's my promise to you as your host, David Scranton. It's an important promise for me because we're all grown up now. And you know that noise and distraction isn't going to help you make the most of your personal finances. It's simply not going to help you make better decisions with your money. I've been on the air over 300 times as a guest on other business news. So when they asked me if I'd do an investment show, I told them under one circumstance. Only if my program could be useful and meaningful for people in my generation. Why? Because people approaching or in retirement don't deserve an angry journalist telling them how to think politically, globally, or even environmentally. You simply don't need that. I am a career financial analyst, an author, and a businessman who wants to use real insight to discuss with my guests, those who are at the top of their respective fields, new avenues to completely address some of the most perplexing questions that you are most likely experiencing. Welcome to the income generation. For those of you who aren't in this age range, we're sure you'll find the wisdom presented in the next hour more than worthwhile, especially tonight's show, where we welcome our guest, author and famed economist, Harry Dent Jr., to answer questions that are critical to people of all generations. He's here to help us discover trends and connections that no one else unearths. I've personally been following Harry for 20 years and could say that with 100% conviction. Today we're going to ask Harry point blank what he thinks is going to happen next with interest rates, with the stock market, with gold and real estate. My own understanding of what drives the major markets expands every time I've spoken to Harry or read one of his books over those 20 years I was discussing. His unique research lays out well-grounded, common-sense causes for market moves, past, present, and future. Frankly, Harry Dent highlights associations that most analysts aren't even looking at, that they don't even know exists. And he makes it absolutely clear to his audience how he derives his forecasts and tells them exactly what this forecast means to you. So anyone who's working, has worked for 35 to 40 years or more, deserves to be able to know that they will have a steady income to at least take care of their basic needs, if not to provide for a life that takes full advantage of the free time found during retirement. I've been helping my clients and even my radio show listeners enjoy this portion of their lives for years now. And I'm thankful for the opportunity that Newsmax has presented for all of us to get to know each other each Sunday at this time. And I encourage you, if you're not the sole financial decision maker in your household, to grab the person with whom you share this important responsibility and get ready for a fun and informative hour.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
This brings us to tonight's Income Generation Market Breakdown, where we shed light on what's going on in the economy and markets that most affect you. It's been over a year since the Federal Open Market Committee, or what's called the FOMC, ended its so-called quantitative easing. This was a drastic move which was designed to provide life support and stimulus to a near-dead economy. I call it economic steroids. The strategy, which included the Federal Reserve purchasing $3.5 trillion in bonds, an amount roughly the size of the German economy, in order to inject cash into the U.S. economy and support low borrowing costs. This strategy was in addition to an earlier plan to keep short-term interest rates around zero, where they remain today. Since the beginning of the so-called quantitative easing, or QE as it's called, critics have argued that these steps would fuel inflation and cause asset bubbles in markets that thrive on low interest rates. When these quantitative easing purchases ended, however, in October of 2014, most expected interest rates to begin to rise almost immediately. Well, so far, over a year later, interest rates have not gone up, and the inflation spike hasn't materialized. For 2015, in fact, inflation is only up 0.1%. So does this prove that these many experts were wrong? Well, whether asset bubbles resulted or inflation will become a problem still remains to be seen over the long term. The U.S. is still in uncharted territory when it comes to these new economic and monetary policies. The good news, however, for pretty much everyone, is that the economy didn't falter after the cash injections ended, as some had expected. The less than good news, however, is that the economic pace didn't take off either. With a year of lackluster employment gains, weak corporate earnings, low growth in production, which is measured by the GDP, the gross domestic product, as well as faltering global economies, there has been a long drum roll, so to speak, while the markets have waited for the Fed to raise interest rates for the first time in a decade. Now, we may finally get what we've been waiting for in the middle of this month, a small rise in short-term interest rates, but frankly, I wouldn't even bet my life savings on that. It isn't just the big money on Wall Street waiting. The income generation, many of you, many whom have retired or going to be retiring shortly, who expected in their retirement plans or pre-retirement plans to earn 4 or 5% on bank deposits or in bank CDs or other products or investments, have had to tighten their belts for 8 years or more. Interest rates this low for this long were just not part of the plan for retirees. After the last FOMC meeting in October, the Fed's statement explained that what they'll do in terms of interest rate increases will be dependent upon economic data. Well, up until now, we really haven't had data that screams for higher interest rates. Does this mean the drum roll may continue through the meeting on December 15th and December 16th? Well, again, it's quite possible. I wouldn't necessarily hold my breath on rates going up on December 15th and 16th. No matter how you slice it, though, it is a close call. The economy is just not that strong, and inflation just doesn't seem to be a problem right now. But here's some economic news to get you going. The good news is that gasoline prices, as most are aware, are down roughly 50% from this time last year. and they're likely to stay down as output and inventory levels for oil continue to be high, and demand for oil in a weak global economy is simply not expected to strengthen. Prices in most of the country are now just above $2.20 a gallon, or about 70 cents a gallon lower than they were a year ago. Maybe we'll get a Santa Claus gift and have prices under $2 a gallon by Christmas. You never know. But before you hop in that car and take that trip, stick around. Why? Because we're all going to find out from Harry Dent what he sees over the horizon for all of us. And then we're going to drill down and make it more personal to you as individuals. In fact, this should get really, really interesting, because if you've read Harry's most recent book, you'll know that sex actually plays an important role. So I'm sure you're going to have a lot to think about and talk about at your holiday parties. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. Over the last 3 decades, today's guest has been relied upon by business executives, financial advisors, and investors around the world. He's appeared on Good Morning America, PBS, CNBC, and CNN Finance. In fact, you may have read his commentary in Barron's, Investor's Business Daily, Entrepreneur, Fortune, U.S. News & World Report, The Wall Street Journal, or Omni. In fact, he's a regular guest on Fox Business's Nightly Scorecard and has written numerous books. In Harry Dent's 1992 book, The Great Boom Ahead, he had very little company as he accurately forecasted the unanticipated boom that defines that economic era. That same year, he also authored 2 consecutive books, The Roaring 2000s and The Roaring 2000s Investor. If you read his 2004 book, which included 20 years of forecasts called The Next Great Bubble Boom, you may have been prepared for the 2008 economic and financial collapse. In fact, back in 1989, this week's guest warned that Japan's collapse was inevitable. And in the 1990s, he nailed the rise and fall that was the dot-com bubble. I was following his work in 2006 when he warned a housing bust was on the horizon. And in 2008, those that listened may have been able to save a lot of grief by successfully positioning themselves for the credit collapse and collapse in equity values. So it's no surprise that he was right on these forecasts, because he's a Harvard-educated economist, author, and publisher, and highly sought-after speaker. Harry Dent also has a popular newsletter with over 300,000 subscribers. We'll be grilling Harry today to better understand his methods, what he forecasts for the income generation specifically, and hopefully have a little fun discussing what all of you individually can expect within your own households. Harry, welcome to the show.
Nice to be here.
Great to have you. You say that governments are fighting unprecedented demographic and debt trends that could only be fought so long with artificial stimulus and this thing we call quantitative easing. Harry, give us an idea of these trends that you're observing.
Well, first of all, the baby boom generation around the world, largest generation in modern history, dwarfs the generation before it and somewhat the generation after it. So it first peaked in Japan in the late 80s. We were the only people that saw that, because we have a spending wave, peak spending at age 46. We moved forward the birth trends for then until when a generation is going to spend and not, and it told us Japan was going to dive in the 90s just when people thought it was going to take over the world. And Germany has the worst trends today in Europe, and nobody's going to see that coming. But the United States peaked in 2007. We predicted that 20 years in advance. Baby boomers would peak, the spending momentum would go down, and we've had quantitative easing ever since in 2008 forward. So that's number one. Demographic trends are peaking in one country after the next around the world. Europe is the next to get hit hard. And then debt, twice the debt compared to GDP that we had in the Roaring 20s bubble. Only happens once in a lifetime, and debt causes financial asset bubbles. So these things have to burst. And of course, the last time they did, we got the 1930s.
Of course. Now, it's funny you mentioned Germany, because if that's true, then that doesn't bode well for the euro. And then you also mentioned, you told me that the issue that China's facing right now could even be far worse than that. So tell us.
First of all, China's the only emerging country, because they have all the demographics in the decades ahead, all the demographic growth. China is the only emerging country that actually their workforce is already shrinking slowly since 2012, and after 2025 it falls off a cliff like Japan. And China has the greatest bubble I've ever seen in modern history. They have overbuilt 27% condos empty in major cities. Whole cities of 1 million plus, nobody in them. You know, railways, roadways, bridges to nowhere. And the biggest mall in the world is empty, and they turned it into a tourist attraction. So they've overbuilt everything, moved people massively. China is the greatest bubble I've ever seen. If it doesn't burst in the next 4 to 5 years, I will move to Australia and become a limo driver and quit economics. I mean, it's that obvious to me.
Interesting, interesting. Now, how about the dollar and gold? You expect the dollar to rise, and you expect gold to drop, which is kind of going to surprise all the gold bugs, because most people say, and I'm sure you've heard this, that gold does well during times of financial crisis. So tell me your view on that.
The biggest financial crisis we had recently was in the second half of 2008 when the whole system blew up. Gold went down 33%, silver 50%, commodities down, real estate down, stocks down around the world. The only thing that was up was the U.S. dollar and the highest quality bonds. So the gold bugs are wrong. I've studied gold back to the 1600s. Adjusted for inflation, it does not appreciate. And it makes no income like real estate, which also does not appreciate long-term adjusted for inflation. So gold is an inflation hedge, correlates beautifully with inflation. So the 70s was the time to own gold. We're moving into a deflationary period, which always follow these financial bubble and debt bubble burst, because money's destroyed. I mean, literally trillions of dollars will be destroyed. And so deflation does not favor gold. So I have more bets with gold bugs than you can imagine, and I'm winning all of them at this point.
Yeah, you and I definitely agree with all those terms, deflation over inflation, looking forward, and so on. Now, another place where we agree, which is very interesting, is, and I'm sure we agree, but for different reasons, as is normally the case between us, you predict that we can very well see a Dow Jones Industrial Average down around 6,000 or so. And I'd like to hear your side of this and why you believe so strongly that that's likely to happen probably by 2017, I think you said.
Yeah. I mean, there's a pattern that is so obvious nobody's seeing it because nobody wants to see it. I call it the megaphone pattern. And we had this stocks peaked in 65, 68, and 72, 3 peaks higher and 3 crashes lower. And it ended with the horrible 73 to 74 crash. So the Dow peaked in 2000, then it peaked higher in 2007, and now higher in 2015. But each crash has taken us to lower lows. This pattern says it's peaked. The final, you only get 3 of these. And then this final peak will take us in the next year or two down to about 5,500 to 6,000. So that's just a really good guess. You can only guess in the short term. I can make incredible long-term predictions. That's easy. But that's my most likely scenario, a bigger crash. And people always say, oh, Harry, that's too bearish. I think we just saw 6,400
of course
in early 2009 and 2 big crashes. And people are telling me this can't happen after 6, 7 years of total artificial stimulus. How can you ever have a sustainable economy on free money created out of nowhere?
Mm-hmm. And isn't it also true that in every one of these long-term bear markets we've ever had, we've always had at least 3 major drops? We've never had one with just 2?
That has been more typical. In the Great Depression, we had 2 major drops. Actually, when you go all the way to early 40s, 3s, that right. is typical. And when you see, after bubbles, the typical bear market is 80%, not 50 or 60. In Japan, their peak, the bottom, is 80%. And again, I keep telling people, look at Japan, their baby boom, they had a real estate bubble, a stock bubble way before the U.S. and Europe, because their baby boom peaked just before and after World War II. So way ahead. Now the U.S. is following, and people say, oh, real estate will come bouncing back. No, it hasn't bounced back in 24 years in Japan, and it went down 60%, and commercial went down 80%. Real estate will never be the same when the next generation does not replace the baby boomers in size and numbers of people. Net demand is going to go down for decades. So real estate's not going to come roaring back.
Of course. Now, what's interesting is you and I, as you well know, have agreed with each other over the years on most topics. And the one place that I disagreed one time was back in the very, very late 1990s. I was predicting myself that we'd be slipping into a bear market cycle. And at that point, you were talking about a Dow possibly at 30 or 40,000. And I know shortly after that, you must have gotten some intelligence, some research that got you to change your prediction and be more in line with mine. Tell me what made you change at that time.
Yeah, we have an 80-year cycle, 2 booms, 2 busts, an inflationary crisis and a deflationary crisis. I call it spring, summer, fall, winter. And so we look back at the last fall season, which was in the early 1900s into the roaring 20s, and there was a first tech bubble, and then it crashed massively, just like in the early 2000s. And then there was a second one that was even stronger. So I was expecting that to happen again. And then, so we got into that. We told people to buy stocks again in October 2002, right at the bottom, literally right at the bottom. But I thought stocks were going to bubble up even more. And what I had to do about halfway up that, I said, you know, something's wrong here. We're not seeing it. It's still a bubble. Stocks double, but we're not seeing that strong bubble. What was different in the roaring 20s? I came up with 2 new cycles, a 30-year commodity cycle, killer accurate, and a geopolitical cycle, which is so important today because this said 83 to 2000, great geopolitical environment. Nothing went wrong in the world, but 2001 to now and for the next 4 years, horrible.
And Harry, we need to take a quick break, but as soon as we get back from that break, we're going to ask Harry more questions about his predictions, almost all of which have come true, so don't go anywhere. We'll be right back.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 core values to help protect your money in good times and bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
We're here with world-renowned economist Harry Dent, and we're talking about, first of all, your new book, and we're also talking about some of the predictions you've made, past, present, and future. Now, just before the break, you mentioned that one of the things that got you to change your prediction in the late 1990s going into the early 2000s was geopolitical considerations. So could you talk just a little bit more about that for a moment, please?
Yeah, there is a geopolitical cycle that I've now tracked back 200 years. And it's 17 to 18 years positive. Example, 1983 to 2000, nothing went wrong in the world of any significance. 2001, 9/11 to now, everything's gone wrong. Right. And we've got 4 more years in this down cycle. Stocks are valued at 50% less in the down cycle of this. So if I'd have had this cycle in the late 90s, I would have been predicting a Dow of 16 to 20,000. I would have cut that in half because of this one cycle. It's a very powerful cycle, and it continues. The Middle East and everything we're seeing today is not going to get better for at least 4 more years, until at least early 2020.
I have to agree with that. And of course, that 16 to 20,000 point Dow range is exactly where we are today, which makes sense to me. You also mentioned the 30-year commodity cycle was something else that you discovered as a result of the tech bubble bursting, before you had thought it would happen. Tell us about that.
Yeah, in the roaring 20s, that final bubble that I was kind of looking at, commodity prices were falling. In the 2002 to 2007 bubble, commodity prices were rising, in fact, very strongly. So rising commodity prices are not good for earnings and not good for the economies of developed countries. And the collapse of this commodity cycle, again, it's right on 30 years, 1920, 1949 to 51, 1980, and then now a double top 2008 and 11. I mean, right on 30 years. Emerging countries are greatly underperforming the global markets because commodities are collapsing, and that's the business they're in. They are commodity exporters.
Interesting. Very
Except
interesting.
for India, and that's why India is doing well when everybody else is not.
That's awesome. I love that. I learned so much from you over the years, which makes this, just really makes it enjoyable having you here today as a guest. Now, I know that most of what you do tends to be based around demographic trends. The question I have is really simple. How do you see that being affected by immigration, by refugees into the United States? How is that going to make things different?
Well, immigration is huge for countries like the United States, and even more so for Canada, Australia, Singapore, and countries like Switzerland. These are some of these smaller countries, the only ones that have a larger echo boom than the baby boom. So I actually calculate in my birth index, which I move forward 46 years for the peak in spending, I calculate in all the legal and illegal immigrants, past and future forecasts, because I can take a computer model and say this is when they were born. Right. So they are in that index. Immigration has a huge impact on demographics, just like births. In fact, even better, because immigrants come in working age, ready to go. Kids you have to raise for 20 years before they enter the workforce on average.
Got it.
So they're a cost, not an asset at first.
It actually makes sense. You know, it's funny. I watch all the talking heads on television. They're spouting out numbers. And what you say to me is just common sense. It just makes sense to the average person who's listening. Now let's talk about your book. In the demographic cliff, you speak about spending patterns at different ages, stages of our lives. What are some of the key times and turning points that you find as we grow throughout the years?
Well, workforce entry, age 20. On average, some at 18, some at 22 college, but 20 on average. That's when inflation, the cost of raising these kids, the biggest factor in inflation is people, not monetary policy. Milton Friedman was wrong on that one. And so then they start this great spending, and they get married and have kids and stuff. And you know, so they'll spend the most money on child care, 33, but they'll buy their first home, 31. They'll buy their biggest home, 41. They spend the most money at 46. That's the next big turning point. But for the affluent, who are still spending after 2007, when we said overall the economy would peak, the most affluent 20% drive 50% of consumer spending now, and they don't peak until 54. They go to school later, their kids go to school later, their whole family cycle is later. And because of the high income inequality, because QE is raising stocks, these people are doing very well. But my big surprise, other than Germany, as we said, and China falling, the U.S. affluent sector is going to take a dive in 2016, as are auto sales, which has been the strongest sector. Auto sales peak at age 54 and then drop like a rock. Nobody's going to see this coming.
Well, I'm glad to hear I'm past my peak spending years. That's good news. It could be a little bit easier on me from this point forward. You know, tell our viewers for just a moment, in the demographic cliff, tell them 2 or 3 things that they are going to get, that they are going to learn, that they could take home to manage their own personal finances in what you and I both perceive to be a much wiser way.
Well, again, what we say is we can tell people the key economic trends that are going to impact their life, their business, their family, their investments over the rest of your lifetime. Long-term trends are easy to predict. What the stock market's going to do next week or month is very difficult, and I can only guess. And if I'm really good, like October 2002, I say buy stocks here. You know, I can be right maybe 2 out of 3 times, but long-term is different. So demographics is key. We predict inflation on demographics, not on monetary policy. Who knows what the Fed's going to do 5, 10 years from now? I know when people are going to enter the workforce, and that correlates with inflation better than any indicator. We predict the spending, when generations are going to spend more and not any country in the world 4 to 5 decades in advance. So we can tell you, for example, 1983 to 2007 was the baby boom boom, and we always said this will be the greatest boom any of us will see in our lifetimes, because the next generation is nowhere near as steep or does not go as high. The next great boom in the world, we look at the emerging world. India is the next big thing, almost guaranteed, unless they just totally screw it up politically, and they're moving in the right direction for once. China is not going to see the same boom they saw. India is going to be the one large country that's going to grow, and Southeast Asia and India and that part of the world is going to be the center of the world for the next decades.
So when I look at this just in the last 60 seconds or so we have today, you know, first of all, it sounds like you're saying don't run out and buy the new home, buy things today, because we're in a deflationary cycle. Cash might very well be king at some point down the road, correct? Great. And it sounds like you're also saying that as far as the stock market's concerned, be careful. At least at bare minimum, have one finger on the trigger, because there is another major drop, whether it's 2016, 17, or 18. We don't want to get pinned down. You're too smart for that. I get that on the time frame. But at bare minimum, to warn our viewers of the fact that you need to be careful about the stocks you hold, and especially, it seems to me as if you need your money in the next 10 years or so, you want to be really cautious and have one finger on the trigger and not get greedy, because the old saying, pigs get fat and hogs get slaughtered, right?
Exactly. Cash and cash flow are king in what I call the winter deflationary season. None of us have seen that. The last one was the 30s, so people don't understand. Asset allocation doesn't work in the winter season when all bubbles burst except the safest bonds and currencies.
That's right.
And also bubbles, when they burst, and we just saw it in China, and we saw it in 1929, 40% down, 42% down in the first 2.5 months. Half the whole 80% move was made in the first 2.5 months. You're better to get out a little early and give up that last 5% than to wait until it's obvious, because bubbles burst much faster than they build.
That's perfect. You heard it straight from the mouth of Harry Dent, the author of The Demographic Cliff. We'll be right back. If you're not using someone who's well trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. Since 2008, most people have had the sense that the economy, both here and abroad, has not quite gotten back to full acceleration yet. Although most people feel a bit more comfortable about their personal situations, and the economic reports on jobs and consumer confidence confirm that we're in better shape now than we were then. Closer to home, our neighbor or possibly our son or daughter, who's been unemployed for a long time now, are back to work, although they probably don't have the income or benefits that they're used to. There still seems to be this feeling of overall sluggishness in the economy. In fact, I liken today's economy, and that over the last few years, to the cars of the mid-1970s. You might recall the Ford Mustang II came out in 1974, and it was supposed to be the next generation of Ford's popular pony car, but somehow was just a shadow of its predecessor. Rather than continue on the path of glory, the Mustang II was described as a Pinto, only heavier. The car was in fact built on the frame of the Pinto and even came with the same 80 horsepower four-cylinder engine. But it weighed much more than the Pinto itself. Ford eventually gave it more engine options and it became available with some stickers and decals to dress it up a bit, but underneath it all, a few more horsepower and some fast-looking pictures of snakes and such didn't really make up for what was under the hood. In fact, the same can be said today about the U.S. economy. We've had a lot of economic enhancers and add-ons over the last few years. Some of these include interest rates that approximate zero, as well as quantitative easing worth trillions. These were quickly bolted onto what still feels like an underpowered economy, encumbered by its own weight. Janet Yellen and those before her have tried all they could do to add spark, but most still feel that around every corner we just may stall. Now, she shouldn't feel bad about this simply because, just like that second-generation Mustang, even the cast of Charlie's Angels and Farrah Fawcett couldn't do much to breathe life into this poor design, one with an insurmountable drag. And it may not be the Fed's fault. We heard from Harry Dent tonight, and he suggests that there isn't much that can be done to alter today's economic pace. In fact, we all got a lot of great insight from Harry. Overall, he says, cash and cash flow are king today in this, what he calls the winter deflationary season. The economy is fighting both demographic trends, which it has very little say about, and debt trends, which won't quickly unwind. As long as the current direction is maintained, the Fed and the rest of Washington can supercharge the economy all they want. It just can't go much faster than it is going right now. So I want to take this opportunity to thank Harry Dent for coming on and sharing his insights. To get your copy of his book, The Demographic Cliff, How to Survive and Prosper in the Great Deflation, go to harrydent.com. It's a great read, one you'll want to keep handy as you consider your portfolio as well as other assets. Now, after you've finished on Harry's site, head over to theincomegeneration.com. Tell us a bit more about yourself and how you liked the program. We're going to be selecting one of our viewers to receive this die-cast 1976 Cobra II, a scale model of the car driven by Farrah Fawcett on the popular TV show Charlie's Angels. That's right, we're giving away a model car. Eat your heart out, Oprah. Next week, we'll be welcoming to the Income Generation market analyst Tobin Smith.
It did because they were in a transformational event, this whole fracking world in the United States, and people sort of got visions of sugar plums in their head and said, my gosh, we're going to be going from 9 million barrels a day to 20 million barrels in the United States, and we better build every pipeline we possibly can. Well, guess what? It's a cyclical business. The faster something transforms, the faster something saturates. So whether...
Now, you may remember Tobin from his 13 years as anchor and contributor to the Fox News Channel and Fox Business Network. Now Tobin is CEO of a unique investor relations organization called The Next Big Thing. Together we'll explore industries that are set to take off and change the way things are being done today. Tobin is always full of surprises, so there's no telling if he'll be talking to us about microsatellites, 3D printing, smokeless cigarettes, or smart fabric for men's underwear. I promise it will be enlightening. We're also going to call upon his background as an analyst to discuss the perils of continued low interest rates in the economy. Finally, I'd like to thank Marty Johnson for her insightful report. We look forward to hearing from you again next week. You know, we're all shaped by what surrounds us, and sometimes it's difficult to step back and to see where we are, what path we're following, and whether or not it still makes sense, or if it ever made sense at all. This includes investing strategies throughout our lives. I've put together a special report for you, the income generation, to help you evaluate which path you're on, where you should be heading, and whether your current direction could safely get you there. The report is being given away to my viewers. So go to theincomegeneration.com now and sign up for your special report written to help you invest for retirement with your purpose in mind. I'm David Scranton. You've been watching The Income Generation, and we'll see you all again next week.
Right now, log on to theincomegeneration.com. That's theincomegeneration.com. Then download your free special report detailing why mutual funds actually hurt investors, where to invest now that best suits your purpose, what Wall Street wants you to believe, and how to give yourself a raise. And while you're there, don't forget to enter for a chance to win the Mustang as well. That's the model car that was featured on today's show. Why cross your fingers and hope for growth when you can read this insightful free report from Sound Income Strategies? Simply log on to theincomegeneration.com. That's theincomegeneration.com, and then download your free report right now.